In this video, we're going to be performing a deep dive on Kimberly-Clark's dividend safety. To begin, let's talk about Kimberly-Clark's business model. Kimberly-Clark is a global consumer products company that sells paper towel, diapers, and tissues in approximately 175 countries. The company operates through two business segments, personal care and tissue. Kimberly-Clark is a well-known dividend stock because of its compelling track record of dividend growth. With 46 years of consecutive dividend increases, Kimberly-Clark is a member of the Dividend Aristocrats Index, a group of elite S&P 500 stocks with 25 or more years of consecutive dividend increases. Kimberly-Clark's 3.6% dividend yield makes it one of the higher-yielding names among the Dividend Aristocrats Index. This has led many investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Kimberly-Clark's dividend safety in the context of the company's current earnings. When Kimberly-Clark announced third quarter financial results on October 22nd, it reaffirmed its financial guidance for the full fiscal year. The company continues to expect to generate adjusted earnings per share of about $6.70 for the 12-month reporting period. For context, Kimberly-Clark currently pays a quarterly dividend of $1 per share, which implies a dividend payout ratio of just 60%. Using earnings, Kimberly-Clark's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Kimberly-Clark's current dividend payments to its free cash flow. In the third quarter of fiscal 2018, Kimberly-Clark generated $692 million of cash from operating activities and spent $219 million on capital expenditures. This implies quarterly free cash flow of $473 million. In the same 3-month reporting period, Kimberly-Clark paid cash dividends of $348 million, which allows us to calculate a free cash flow dividend payout ratio of just 74%. Through the first 9 months of 2018, the picture is quite similar. Kimberly-Clark generated $2.021 billion of cash from operating activities and spent $566 million on capital expenditures for free cash flow of $1.455 billion. The company paid $1.039 billion in dividends during the same time period, for a free cash flow dividend payout ratio of 71%. Using free cash flow, our conclusion is the same. Kimberly-Clark's dividend appears safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Kimberly-Clark's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Kimberly-Clark's performance during this time period is shown below. Although the company experienced a modest earnings decline in 2008, Kimberly-Clark's earnings broadly increased during the last recession. Accordingly, we have no concerns about the company's ability to pay rising dividends moving forward. The last angle that we will use to assess Kimberly-Clark's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. At the end of Kimberly-Clark's third quarter, the company had $8.6 billion of debt outstanding. Kimberly-Clark generated $198 million of interest expense during the same time period for a weighted average interest rate of 3.1%. The following image shows how changes to Kimberly-Clark's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Kimberly-Clark's weighted average interest rate would need to rise to approximately the 15% level before its dividend would no longer be covered by free cash flow. Accordingly, we believe that Kimberly-Clark's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Kimberly-Clark's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.